So I think the narrative hasn't changed that much. I think what it does, it increases the upside risk to gold. I think the potential for slower growth, higher inflation has been one of the key drivers why their investors have really turned to gold this year, and we've seen such a strong move very early on.
Is it the case then that risk aversion created by the geopolitical landscape, particularly tariffs, is still going to work in favour of adding gold to the portfolio?
I think there's still a strong case for investors to add gold to their portfolios as a diversifier, given the extent of risk that we're seeing right now, be it risk to growth, geopolitical tensions remaining in place, and the potential for higher inflation. So I think if we get to a point where stagflationary fears start to gain momentum, I think that creates upside risk to gold. We do think the market can rally through 3,200 this year. We've recently updated our targets. We're now calling for a 3,100 year-end for gold.
And how much is central bank buying part of the narrative? Is there still some mileage there, or have we really seen the peak in terms of the central bank purchases, again, from a diversification point of view?
I think we have seen the peak. We are expecting that the pace of the purchases starts to slow down, but that slowdown is going to be very gradual. So we think that overall purchases will remain at historically high levels, albeit slightly lower than what we saw last year. So they remain a key part of the bullish narrative, not because they push prices higher, but because that they provide a very strong support to the market.
In terms of longer-term drivers for gold demand, we know about India, we know about China, but there's a big push to try to attract a new cohort of investors, especially amongst the younger generation. I know the WGC, World Gold Council, is doing some work in this regard. How much is that worth to the gold market?
I think it's really hard to put a number to it, but I think it is important that gold's investor base has been broadening. And I think that's been a trend that's been ongoing over the past decade, and that's why gold has been very resilient even in 2022 when the Fed was hiking rates. I think it's because of the wider investor base and considering gold really as a diversifier for the portfolio. So, you are willing to look through the negative carry at times because you want to have that allocation.
Onto the PGMs, how exposed are platinum group metals to the EV sector, and the EV sector, as we all know, being in the crosshairs of the tariff tensions?
So the biggest impact of the EV story has really been more on palladium, and I think a lot of that has already played out. So the downward pressure on palladium prices in the past several years has been on the back of the EV story. So any kind of walking back of that trend, I think, should be net positive for palladium at the margins.
How, just broadly for gold and for the PGMs mine supply, how big of a constraining factor is that on the supply side, and to what extent is consolidation still a story and a theme that we can look towards in 2025?
So in terms of mine supply for gold, it doesn't have that much impact on the price, especially in the near term. In the long term, it matters, but near-term price trends don't really get affected for gold. For PGMs, probably a bigger story. So supply risks out of South Africa, for instance, do matter for platinum. And I think the fact that we're expecting constraints on the supply side is part of the bullish narrative for platinum and part of the reason why we're expecting deficits.
Joni, just a very quick one on copper and the base metals. How vulnerable are they to a deeper correction, perhaps, given the cyclical headwinds and recession talk?
I think there are downside risks there, not just from a demand standpoint, but also from a sentiment standpoint. But ultimately, I think it will go down to the supply and demand factors for these metals. Prices tend to react more to these rather than sentiment.